What's up guys, welcome back to another video on Might As Well Invest. Recently some of you guys requested a video where I analyzed a few companies that will also get you through stock market downturns. And since your guys' wish is my command, that's exactly why today we are going to analyze the consumer giant by the name of Unilever. But as per usual, let's start out with the introduction. Unilever is a consumer giant out of Europe, or to be specific, Amsterdam. Together with their subsidiaries, they focus on operating a network of production and distribution lines of essential consumer goods like beauty and personal care, food and refreshments, and home care. But now let's have a brief look at the key financials which Unilever has to bring to the table. As per usual, let's start out with the company's market cap, which currently sits at right about 159.2 billion. Which makes Unilever already one of the bigger companies out there in the consumer staples space. But most likely all of you know that this valuation does not come out of thin air and can be attributed to a couple of reasons, like for example the revenue of the last fiscal year, which for the case of 2019 sat at 51.9 billion. Let's however break that revenue down a little bit further and have a look at what sector contributes how much to the total revenue. This overall helps us understand how reliant Unilever is on what economic situation and whether there is growth in that space. Coming in the first place of Unilever's business segments, we have the beauty and personal care business, which contributes 21.8 billion to the total yearly revenue. This is then followed by foods and refreshments with 19.2 billion in revenue. And last but not least, we have the 10.9 billion which are contributed by the home care segment. This already shows us that Unilever offers a pretty diversified product palette, but more on that later on. For now, let's take a look at the company's distributions to shareholders. At the current point of time, Unilever rewards their shareholders through the two most common distribution forms, which are dividends and stock buybacks. At first though, let's focus on the dividend, which at the current point of time sits at right about $1.88, equaling a yield of about 3.08%. But while we've now talked about the current distributions, let's also have a look at the past distribution history, as this can indicate how focused on the dividend a company actually is. For the case of Unilever, we can recreate the first payment of a dividend to the year of 1929. When it however comes to constant dividend growth, Unilever probably isn't the best example, as they only have been constantly growing the dividend for 5 years now. However, the dividend already has been at a higher point, but that lies in the past, for quite a few years now. But in order to find out whether the distribution policy is now also sustainable, let's have a look at the numbers. In order to do that, we have to put the total distributions, which includes things like the dividend and the amount spent on stock buybacks, into contrast with the free cash flow. Right from the bat, we are able to see that generally speaking, Unilever's distributions stay below the company's free cash flow, with the exception of the years of 2017 and 2018. In these 2 years, the free cash flow is exceeded quite a bit, which in the long term obviously is somewhat alarming. However, if this does not occur too often, this should not be too much of a problem. But obviously, the distributions aren't everything, and can sometimes only paint half the picture. So let's take a closer look at the financials of Unilever by having a look at the balance sheet. As per usual, let's start out with the year of 2015, in which Unilever's total assets sat at about 58 billion. This was then made up by about 14 billion in equity, 10.9 billion in long-term debt, 4.7 billion in current debt, and 28.2 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using the company's debt and its cash position. For the case of Unilever, this sits at 13.4 billion. But let's set that value to the side for now and get back to it in just a second, after we have taken a look at the balance sheet of 2019. As you are able to see, Unilever's total assets increased to about 72.5 billion. This is made up by about 18.4 billion in equity, 26.3 billion in long-term debt, 4 billion in current debt, and 23.7 billion in non-interest paying capital. But now let's calculate the net debt like we did for the year of 2015. This time, however, we get a net debt of $24.7 billion, which is a pretty decent increase for our time frame. But let's also find out how sustainable the debt which we just calculated actually is, and whether the debt has gotten better or worse. This is done using the EBITDA, which is the pre-tax, pre-interest, pre-depreciation, pre-amortization income of said company. After doing our basic calculations, we are left with a sustainability ratio of 1.62 or 160% in the year of 2015 and 2.06 or 206% for the year of 2019. This indicates to us that the debt has actually gotten less sustainable, but it is still at a fine position, at which you should not worry about it too much. Alright, since we now have the financials settled, let's get our margin of safety by collecting arguments for and against the company. First of all, it has to be said that Unilever is pretty much a prime example of a consumer company. They are diversified into pretty much every segment of our everyday life, and through owning a ton of high-level subsidiary brands, they manage to speak to both the high-budget and lower-budget consumer. This allows them to pretty much pick up the whole consumer spectrum in, for example, the personal care segment with brands like Axe, Rexona and Dove. If you ask me, this pretty much gives them the market-leading role, with their only real competitor being store-owned brands. This, in my opinion, makes them pretty much invincible, even in economic downturns. But take a look for yourself at the revenue. While this isn't the only factor that confirms this, it gives us a fairly decent overview of what I'm trying to show. While their revenue had a smaller downturn in the most recent economic crisis, they pretty much recovered instantly. Remember to keep this with a grain of salt. However, I will reduce my margin of safety for this reason by about 10%. But it's not all great over at Unilever, sadly. First of all, I have to say that while the business is pretty safe, this comes at a certain cost, which goes by the name of revenue stagnation. This obviously isn't the greatest thing, especially if we look at the fact that this trend has been ongoing since 2012. If you now consider that the balance sheet isn't in the prime position that they could go through with acquisitions, you are even looking at a worse picture if you ask me. Therefore, I'm going to add 10% to my margin of safety. But let's also figure out what I would be willing to pay per share of the company and what, in my opinion, is a fair price to pay per share of the company. In order to get the fair value of the stock, we have to take a little look at the historic dividend yield, which in our case is possible for 10 years. For the past 10 years, we had an average dividend yield of 3.34%. This obviously means that you want to buy stock if the yield is above that average. This would mean that with the current dividend of $1.88, a fair price to pay would be $56.28. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 3.34% and my safety margin of 25%. This gives us our target yield of 4.17%, which leaves us with a price to buy the company at of $45.08. Overall, I have to say, sure, the company in itself is not bad and actually has a great portfolio of brands, which is very diversified in my opinion. But the safety that this brings also comes at a cost, which in my opinion at the current point has pretty much more downsides than upsides. Therefore, I personally would rate Unilever a hold for a portfolio, as neither the dividend nor the future outlook lead me to believe that there is huge upside to the investment at the current price point. I personally would consider Unilever more so a way of parking your money in a productive asset. But remember, I'm not a financial advisor. I only do these videos to entertain some of you guys and get you interested in certain companies. I'm only sharing my personal opinion with no guarantee of gains or losses on that particular investment. So always do your own research. This was Might As Well, and I'll see you in the next one.